Right now, your county assessor's office may already have several legal forms available that could reduce, limit, or even permanently freeze the amount of property tax you pay each year. In many areas, there are as many as 7 different exemptions or relief programs, yet countless homeowners never apply for a single one of them. Before we go any further, let's clear up the biggest misconceptions surrounding these programs, because it's the very reason so many eligible seniors miss out. Many people assume information like this only applies to one specific group. They believe property tax relief is reserved only for retirees with extremely low incomes or those facing serious financial hardship. In reality, many programs are based on factors such as age, disability status, military service, or length of home ownership, meaning far more homeowners may qualify than they realize. So if your house is paid off and life is comfortable, you tune out. Or they assume it's only for wealthy people with big estates and accountants on retainer. So if you're living mostly on Social Security and a small pension, you tune out too. Both groups are wrong, and honestly, it goes even further than that. Some of you are thinking, my house is paid off, so the tax doesn't really hurt. It does. It's the single biggest recurring bill you will ever pay on a home you already own outright. The county doesn't care that your mortgage is gone. They send the bill anyway every single year for as long as you live there. Some of you are renting right now and you're thinking, none of this touches you. It does, because your landlord is paying that property tax bill and your landlord is passing it straight to you a little at a time in your rent. When that bill drops for the owner, your rent stops climbing the way it has been. So, this is for every one of you. Whether your home sits at $85,000 in a small town in Ohio, $260,000 in a mid-sized city in Arizona, or $520,000 in a county in California that just got reassessed, there is real money on this list with your name already on it. And I'm going to tell you on every single form exactly which group it helps the most so that nobody watching this video gets to the end and says, well, that one wasn't for me. Because the honest truth is, homeowners at every single income level are quietly overpaying, just in different ways for different reasons on different lines of the bill. Here's the brutally simple reason almost nobody talks about these forms. Your county tax assessor's office is funded directly by the taxes that office collects. Every single dollar of exemption they approve is a dollar their own budget doesn't see next year. So think about what that actually means. The county has zero financial incentive to tell you about a form that lowers what you owe them. They don't call. They don't mail you the senior exemption application on your 65th birthday. Your mortgage company doesn't flag it on your statement. The title company that closed your purchase never mentioned it. And the realtor who sold you the house, the one who made a commission off the sale, absolutely never brought it up either. And here's the number that should make this land. The average property tax bill in this country runs somewhere around $4,800 to $5,000 a year, depending on where you live. In some counties in New Jersey and Illinois, it's well over $8,000. For a homeowner who's 65 today and lives another 20 years in that house, that's somewhere between $96,000 and $160,000 walking out the door over the rest of your life on a bill that, for a meaningful share of you watching, should legally be cut in half or in some cases brought down to zero. I'm Garrett, and what I do on this channel is take the parts of the tax code and the benefit system that are written in language built to be skimmed past and translate them into something you can actually act on. This week, property tax exemptions are maybe the cleanest example I've ever come across of a benefit that already exists, that the law already promises you, and that simply sits there unclaimed because the system was never built to advertise it. So, here's the plan for the next 18 minutes. I'm going to walk you through 7 forms, one at a time in plain English, 5 that almost every state offers in some shape, and two that almost nobody has ever heard of that I went digging for, specifically because I noticed every other video on this topic skips them. And then near the end, I'm giving you two things that, as far as I can tell, exist in no other video covering this. A real month-by-month calendar of when to file each one and exactly what to do the moment the county denies your application, because a denial is not the end of the story, even though most people treat it like one. Here's the single idea that ties this entire video together, so hold on to it. Being legally exempt from a tax bill and actually not paying that bill are two completely different things. The law does not refund you automatically. Nobody at the county mails you a check out of kindness. You have to know the form exists, and you have to be the one who walks in and files it. That is the entire reason this video exists. Let's start fixing it right now. Form number 1 is the homestead exemption. And I need you to really sit with this one because it's the form most homeowners are completely sure they already have on file, and a huge share of them don't. Nearly every state in the country offers some version of it on your primary residence. What it does is take a chunk of your home's assessed value off the table before the county ever runs the math on your bill. In Florida, that chunk is $50,000. In Texas, it's $100,000 off the school portion of your bill. In Georgia, it's a smaller $2,000, but stacked with other exemptions, it adds up. And here's one most people in the Midwest don't know. In Ohio, the homestead exemption can knock roughly $26,000 off your home's market value for the purposes of the tax calculation. And in Arizona, certain counties allow a similar reduction tied to income limits. Every single state does this differently, but every single state, this is real money. And here's where it trips people up. In some states, it's applied automatically the moment you buy the house. In most states, it is absolutely not. You have to file a one-page form with the county appraisal office almost always before a deadline that lands somewhere in the spring, commonly April 30th. Miss it and you pay the entire bill that year with no exceptions. File it once correctly, and in many states it stays attached to that property for as long as you own it. One piece of paper filed one time can mean hundreds, sometimes thousands of dollars off your bill every single year for the rest of your life in that home. Now, here's who this helps, and the answer is everyone, just differently. If you're a lower-income homeowner, that $50,000 exemption in Florida or that $100,000 exemption in Texas can knock a third or more straight off your bill. And if you're a comfortable retiree sitting on a home that's nearly doubled in value over the last several years, the homestead exemption is also your gateway. Because in most states, the county will not let you apply for the senior exemption, the freeze, the deferral, or the circuit breaker until your homestead is already on file. So if you take exactly one action after watching this video, make it this. Call your county appraisal office tomorrow morning and ask word for word, is the homestead exemption currently on file for my property in my name? If the answer is no, your very next question is which form adds it and what the deadline is. That was the warm-up. Form number 2 sits directly on top of it, the senior or age 65 exemption. Most states that offer a homestead also offer a second separate exemption that switches on the year you turn 65. And this is the one the county will almost never proactively send you. It's a different application. You have to ask for it by name. In Texas, every homeowner 65 or older receives an additional $10,000 off the school portion stacked right on top of the $100,000 homestead. In Florida, the senior exemption can add another full $50,000, effectively doubling your total exemption. In New York, qualifying seniors can see up to half of their assessed value wiped off the books. And here's one that flies under the radar. In South Carolina, homeowners 65 and older can exempt the first $50,000 of their home's fair market value from all property taxes, not just the school portion, which is a meaningfully bigger win than what most states offer at this stage. And now here's the part where comfortable retirees check out and where you really shouldn't. A number of states attach an income limit to the senior exemption. New York cites around $58,000. Illinois, around $65,000. If your income is above that line, you assume you're disqualified, so you never even pick up the phone. But more than half the states that offer a senior exemption have no income test whatsoever. Texas, Florida, Georgia, Tennessee, Mississippi, Alabama, South Carolina, age-based full stop. You turn 65, you file the form, you get it. Your bank balance, your home's value, none of it matters to the eligibility. So if you are 65 or older and you own the home you live in anywhere in this country, your job this week is to call and ask, what is the senior exemption application called in this county? What's required to qualify? And when is it due? Now we get to the one that actually moves the needle in a serious way. Form number 3 is the senior assessment freeze, and without exaggeration, it is the single most valuable form on this entire list. Here is exactly what it does. The year you turn 65 and you file the freeze application, the county locks in your home's assessed value at whatever number it sat at that year. From that moment forward, no matter how much your neighborhood gentrifies, no matter how much your home appreciates, no matter how high values climb across your zip code for the next 20 years, your property tax bill keeps getting calculated against that frozen number. Your home's market value can climb, your tax bill does not move. Let me make this as concrete as I can with 3 different states because the mechanics genuinely differ and you need to know which version applies where you live. In Texas, once you file the over 65 tax ceiling application, your school district property tax is frozen at the actual dollar amount of the bill. Not even the assessed value, the bill itself, the year you turned 65. Your home can triple in value. That number cannot go up. In Illinois, the senior assessment freeze locks in your equalized assessed value as long as your household income stays under a state set limit, which currently sits in the mid-65,000 range. And in New Jersey, the senior freeze actually goes one step further. It refunds you in cash every dollar your property tax has risen above the year you first qualified, as long as you stay current and re-certify annually. Now, here's where this gets genuinely painful for the exact group that assumes this video isn't for them. The comfortable, paid-off house we're doing fine retiree because the freeze is most valuable in precisely the kind of neighborhood that group lives in. Picture this. Your home was worth $240,000 the year you turned 65. It's worth $480,000 today. If you never filed the freeze, you are being taxed on the full $480,000 every year for the rest of your life. Your neighbor across the street, same model home, same year built, same lot size, filed one form and is still being taxed as if their home were worth $240,000. At a typical combined rate, that gap alone can run $2,500 to $4,000 a year. Now stack the homestead exemption and the senior exemption on top of that frozen base, and you can end up with a bill that runs 40 to 60% lower than the house 2 doors down permanently for the rest of your life in that home, one form. That is the entire difference between those two households. There is one rule on the freeze you absolutely cannot afford to miss. In most states, you have to file it within a specific window. Typically between January 1st and the end of April, the year you turn 65, or in some states, the year directly after. Miss that window, and in a number of states, you lose the freeze permanently. It does not come back around. That is exactly why I'm the loudest about this particular form. And here's the good news for anyone who's already past 65 and just realizing they never filed. In many states, you can still apply right now. The freeze applies going forward, not backward, which means every additional year you wait is simply another year of overpayment that nobody will ever hand back to you. Call the county today. Ask for the senior tax ceiling or senior assessment freeze application by its exact name. Form number 4 is one almost nobody outside a tax office has ever heard the name of, the circuit breaker. And it's aimed squarely at homeowners living on a modest or fixed income, which, if you're retired and living mainly on Social Security and a small pension, very likely includes you. The name comes from the idea in home electrical systems. When the load crosses a certain threshold, a breaker trips to protect you. Here, when your property tax bill crosses a certain percentage of your household income, typically somewhere between 3 and 6% depending on the state effectively trips the breaker and refunds you the difference. Here's the part that explains why almost nobody knows this exists. It is a state form, not a county form, and it's usually filed as a credit attached to your state income tax return. Even in years when you owe no state income tax at all, you report your household income. You report what you actually paid in property tax that year. And if the math crosses that threshold, the state either cuts you a check or applies a credit for the difference. Massachusetts, Maine, Vermont, New York, Michigan, Minnesota, Missouri, Maryland, Wisconsin, and Illinois all run versions of this for seniors with payouts ranging from a couple hundred up to well over $1,300 in a single year. And 2 more that rarely get mentioned in this context. Many states offer property tax rebate programs that return hundreds or even thousands of dollars to qualifying seniors each year. Pennsylvania's property tax/rent rebate program, for example, can provide up to about $1,000 annually, even for renters, while states like Connecticut offer similar circuit breaker programs with income limits that are often much higher than people expect. These programs are designed for many middle-income retirees, not just low-income households. Another valuable but lesser-known option is the Property Tax Deferral Program. Available in many states for homeowners over 62 or 65, it allows eligible seniors to postpone paying property taxes until the home is sold or transferred. The deferred taxes become a lien on the property, usually with relatively low interest. For retirees who own valuable homes but live on fixed incomes, this can provide significant financial relief. However, homeowners with a mortgage should first confirm that their lender permits participation. Veterans should also review disabled veteran property tax exemptions. Many states offer substantial reductions, and in some cases eliminate property taxes entirely for veterans with qualifying service-connected disabilities. Surviving spouses may also qualify in certain situations, so it's worth checking local rules. One of the most commonly overlooked benefits involves surviving spouses. After a homeowner dies, exemptions such as senior freezes or veteran benefits often do not transfer automatically. Missing the application deadline can cause property taxes to increase dramatically just when household income has fallen. Finally, remember that every property tax bill is based on the county's assessed value of your home. Because assessors often rely on estimates rather than inspections, values can be inaccurate. Nearly every county allows homeowners to appeal their assessment, and many appeals result in lower valuations and reduced tax bills. The best time to review your assessment is when your annual notice arrives, since appeal deadlines are usually only 30 to 60 days. Appealing costs little or nothing and can increase the value of every other exemption you receive. Most counties enforce these deadlines strictly, and simply forgetting to open your mail is not considered a valid excuse. Around your 65th birthday, many states open the filing window for senior exemptions and property tax freezes, so it's important to verify the rules where you live. Spring is also when most homestead exemption deadlines occur, while circuit breaker credits are often claimed through your annual state tax return, even if you owe no tax. If you've recently lost a spouse, filing the surviving spouse application quickly can help preserve valuable tax protections before your property is reassessed. Mark these deadlines somewhere you'll see them often. The biggest reason eligible homeowners miss these programs isn't because they don't qualify. It's because they simply forget to file on time. If your application is denied, don't assume the process is over. Many first-time denials happen because of missing documents, simple paperwork mistakes, or deadline misunderstandings, not because the homeowner is ineligible. Request the denial in writing, correct the issue, and submit an appeal. If necessary, most states allow you to take your case before a county review board or tax tribunal, often without hiring an attorney. Remember the 7 key property tax relief programs: the homestead exemption, senior exemption, assessment freeze, circuit breaker credit, property tax deferral, disabled veteran exemption, and surviving spouse carryover, along with your annual right to challenge your property's assessed value. None of these benefits happen automatically. Your county won't remind you, your mortgage company won't point them out, and many tax preparers won't mention them unless you ask. The homeowners who save thousands each year aren't simply luckier. They're the ones who knew these programs existed and took the time to apply. If you know someone over 65 who may qualify, share this information with them. It could save them years of unnecessary property tax payments.